So now we've talked about fiscal policy, but that's not the only option available to us, and according to some economists, that's not even the most important option. This other thing is what I'm going to talk about today. From the very beginning of our nation's history, we've had a big debate over how to deal with our banking system. That's not something new. Right from the beginning, we had the Federalist Party and the Anti-Federalist Party, and the Federalists believed that we should have a central bank. And that faction, insofar as they wanted a central bank, was led by Alexander Hamilton. Whereas the Anti-Federalists, led by Thomas Jefferson, didn't believe that there should be a central bank. In other words, some central institution run by the government that sort of regulates the banking system. And the debate comes back to what we've talked about before. Should it be controlled, or should we sort of leave it alone? We've sort of gone back and forth on this. George Washington was our first president, and he named Hamilton the first Treasury Secretary. And so we had the first Bank of the United States for about 20 years. And then 20 years later, Thomas Jefferson was the president, and he nixed the whole thing. And then not too long after that, we had the second Bank of the United States. And after 16 years, Andrew Jackson, who really did not believe that the banking system should be controlled, by a few elites on the coast, axed that. So we got rid of the second Bank of the United States, and for a long time, we didn't have a central bank. During the Civil War, we actually strengthened the sort of power of the federal government to regulate banks, mainly to raise money for the war effort. So the federal government actually began printing money, which it hadn't done for a very long time. Believe it or not, it was not the federal government that printed money prior to this time, but they printed greenbacks in order to try to fund the war effort and passed several banking acts to strengthen the federal government's ability to regulate banks. In 1913, President Woodrow Wilson signed into law the Federal Reserve Act, which created what was then and still is today our central bank. Okay, one bank that sort of regulates the entire national banking system in response to the Panic of 1907. So people thought at that time that we need a central bank that can not only do something to regulate the banking system, but at that time it was mostly an effort to provide a way for banks to get short-term loans to try to cover temporary shortfalls. Like if there was a run on the bank, like everybody tried to go to the bank and get their money out. Obviously, the bank doesn't have everybody's money because they've lent a lot of it out. So if that happened, the bank could borrow from the Federal Reserve for a short period of time until the crisis passed. Now, of course, this couldn't stop the Great Depression that happened 16 years after, or that started 16 years after the Federal Reserve Act. And during the presidency of FDR, Franklin Delano Roosevelt, during the New Deal, there were some further reforms designed to strengthen the Federal Reserve's ability to act sort of as one unit across the whole country with one policy. And they put into place something called the FDIC, the Federal Deposit Insurance Corporation, that would guarantee people's bank accounts, okay, so things like checking accounts, savings accounts, certificates of deposit, up to a certain amount. Now, all of that is well and good, but over the course of the existence of the Federal Reserve Bank, economists have realized that the Federal Reserve's regulations can actually be used to alter the money supply. And by altering the money supply, they can influence the economy. So that's the other option that we have for influencing the economy. As opposed to fiscal policy, this is monetary policy, which are actions designed to change the money supply and interest rates in order to influence the economy. So this monetary policy is controlled by the Federal Reserve. But how is the Federal Reserve? Who is the Federal Reserve? What is that? So basically, the Federal Reserve Committee that makes these decisions. The Federal Reserve is a very large thing, and I'm not going to go too in-depth about it. But there's a committee called the Federal Open Market Committee that makes these decisions. And the Federal Open Market Committee is composed of 12 people. Okay? 7 of them are the governors of the Federal Reserve, who are appointed to 14-year terms by the president. And he appoints a new one every 2 years, and they're led by their chairman, also appointed by the president. And then there are 5 regional district Federal Reserve presidents who also are on this committee, including always the president of the New York Fed, because New York is the center of the banking industry. Now, it's important to note that these guys are not elected. Okay, they are not elected by you. They're chosen by the president, who is elected, but they serve for 14-year terms. So these guys are more like judges than they are like congressmen, right? They're sort of supposed to be apolitical technocrats who are experts at what they're doing, and that's how they're sort of maneuvering things. But they're not elected. Okay, so if I ask you, who's in control of monetary policy? You can't say the government, because again, the guys at the Secretary of State's office don't have any control over that. Okay, only the Federal Reserve does. In fact, Congress and the President don't have any control over that. Only the Federal Reserve does. Now, I want you guys to be aware that the current chairman of the Board of Governors of the Federal Reserve, so sort of their spokesman, is Ben Bernanke, who was first appointed by George W. Bush in 2006 to replace Alan Greenspan, who had served for a very long time, and reappointed by Barack Obama in 2010. He used to be a professor of economic history, specializing in the Great Depression at Princeton University. And the previous Secretary of the Treasury, Tim Geithner, who served up until January of this year, so this was Barack Obama's Secretary of the Treasury from 2008 to early 2013, used to be, before he was the Treasury Secretary, he was the president of the New York Fed and therefore a permanent member of the Federal Open Market Committee. And so hopefully if you guys watch the Fear the Boom and Bust video that I put under the discussions, you guys noticed that the bartenders who are helping to get Canes, sloshed, their nameplates say Tim and Ben, and that's what they're going for there. Now I'll go into the specifics of exactly how the Federal Reserve changes the money supply and the interest rate, or interest rates, more specifically in another video. But for right now, I'm just going to go over the basics. Now, the money supply thing might sound kind of straightforward, right? Just print more money or take some money out, but that's really in practice not the way it works. What happens is this: there's a certain amount of physical dollars out there, right? Literal dollar bills, $5 bills, 20, 100, and that's called the monetary base. Okay, but that's not the same as the money supply. In fact, it's usually quite a bit smaller than the money supply. The actual money supply is so much bigger exactly because of banks and lending. The way it works is this, okay, you put your money in the bank, and the bank lends out a certain percentage of it. That's what we call our fractional reserve banking system, and all banks work like this, right? So you put your money in the bank, and they lend out, say, 70% of it. So they lend it to somebody else who spends it, or that somebody else puts it in the bank. But one way or another, that money ends up back in the bank, okay? Now, you still feel like you have 100% of your money, and you spend money as though you have 100% of that money. You don't think, well, I really only have 30% of the money because the bank lent out 70% of it. You don't operate that way, okay? But the bank does lend out 70% of it. So you still feel like you have all, let's say, $1,000 that you put in the bank. But $700 is now in somebody else's bank account as well, and the bank lends out 70% of that money, and 70% again. So ultimately, because of lending, you feel like you have all your money, but some of it's being lent out, and the person who borrowed that money is spending that money, is acting like they have that money, and so on and so on. And so the bank, the money that you put in the bank is what's called multiplied, okay, because the bank lends some of it out, and the more money the bank lends, the more multiplication happens. In fact, there's a formula that can tell us. Okay, so all you have to do is divide 1 or 100% by the percent of money that banks are holding on to still. Okay, so if the banks are holding on to only 10% of your money, then 100% divided by 10% is 10. So whatever the monetary base is, you can multiply that by 10, and that's what the money supply really is. Now, as we talked about before, that is a good thing in many ways because it means that money doesn't just lie dormant, it's still being used for investments, for profitable things. But hopefully you're seeing that there's also a risk there, which is that if you need your money back, or if a large number of people need their money back, or get spooked and try to get their money out of the bank, then the system could come crashing down really, really fast. And that's sort of what happened both in 1929 and 2008. But changes in the money supply will also affect the interest rate. As you'll hopefully remember, the interest rate is actually a price, right? It's the price of basically renting money. Now, like any price, the interest rate is actually determined by the supply and demand, but the supply and demand for money. So if you raise the supply of money, in other words, you move that curve to the right, then the equilibrium price is going to go down, and therefore the market price will follow it. And by equilibrium price, by market price, we mean the interest rate. And if you decrease the supply of money, the price of money will go up. In other words, the interest rate will go up. So altering the money supply will change the interest rate, and that's going to have big implications for the economy. That's all I have for this video. In the next one, I'm going to talk about the specific methods that the Federal Reserve uses to influence the money supply and interest rates.